Q2 earnings are out for Walmart, ticker symbol WMT, so let's do an analysis. We are now sitting at a PE of 29, a market cap of 382 billion, and a dividend yield of 1.6%. On the last earnings update on May 17th, we said that the stock would likely bounce at around $118 price figure, and it did exactly that. And the stock is now up 17% from those levels. So let's do an analysis to see what's going on with Walmart, what's impacting their valuations, and see how everything's progressing for fiscal 2023. All right, so starting with our earnings release here, what can we see from the second quarter? And they've highlighted that the company delivered strong top line growth globally, and this is partially driven by inflation. Now, before we jump into all the numbers, what they did well, what they need to improve on, let's actually look at what the CEO said himself. And essentially said that they're pleased to see the customer interaction they've had so far during this period, that they've taken actions to improve inventory levels in the US, along with heavier mix of sales in grocery, which actually ended up putting pressure on profit margins for Q2 and their outlook for the year. However, they made good progress operationally to improve costs in their supply chain. They continue to build on the strategy to expand their digital businesses, including the strength they're seeing in international markets. Okay, that being said, guys, let's jump into some of the numbers here. So looking at our free cash flow figures that they provided with us, we have operating free cash flow here for year-to-date figures of $9.2 billion. This is down $3.2 billion year over year. Then when we deduct for our capex figure here of $7.5 billion, we're left with $1.7 billion in free cash flow. Now, this is actually down $5.7 billion from the same quarter a year ago. But then when we look at our returns to shareholders here, we can see their actual total return to shareholders is $4.9 billion, and that's up 24%. So their free cash flow is going down, but their returns to shareholders are going up. So what's going on there? Let's dive into that exactly. All right, so starting with our consolidated statement of income here, we have net sales and membership sales. This accounts for our total revenues here of $153 billion. This is up 8.4%. That's good so far on top line, as they mentioned, right? But then we have our costs and expenses here. Cost of sales actually increased 10% to $115.8 billion. And then we have our other operating expenses, SG&A, etc., which also increased about 6%. So overall, this led to an operating decline of 6.8%, because when our costs are growing at a higher rate than our revenues, well, obviously we're going to have a negative downturn here, and that's why we have operating income here of 6.8 billion, down year over year. And when we deduct for other expenses, taxes, etc., we're left with $5.1 billion in consolidated net income. Okay, this actually did end up increasing 20% year over year on bottom line, so that also is actually pretty strong. So despite being down in operating income, we still made a sizable increase on bottom line year over year, so that's good as well. And we left with about $1.88 in earnings per share for this quarter alone. We look at this from a 6 months perspective, and we're left with about $2.50 in earnings per share. So we can anticipate by the end of the year, we'll be left with about $5 in earnings per share. So keep this in mind when we get to our valuation at the end of the video here. But before we do that, let's jump into the balance sheet. They have let's call it $14 billion in cash. Then we have short-term debt of $10.6 billion, $5.3 billion respectively. And then long-term debt here of $30 billion. We add all that up, let's say it's about $45 billion in debt. That doesn't look too great, but then when we account for the inventories that they do have on hand, this is a retail business at the end of the day. They have about $60 billion. We add that to the cash figure. Yeah, we can say that they have about $84 billion in current assets, making the debt figure very feasible. And again, for retail businesses, you can expect that they need to have inventory on hand. They are going to have to take on some debt in order to service the needs of the customer here. Now, moving on to our statement of cash flows here for the first 6 months of 2022, we bring down our net income figure here of $7.2 billion, add back in our non-cash cost, depreciation, amortization, etc. We're left with $9.4 billion in operating free cash flows. Deduct our capex figure here of $7.5 billion. We're left with $1.7 billion in free cash flow to reward shareholders, which is in line with our figure that we mentioned at the top of the video there. But then what exactly are they doing with their free cash flows, right? We see they're taking on $10.2 billion in debt. And the reason for this is so that they could service their long-term debt payments, service the dividend that they pay out to the shareholders, and also repurchase some shares of stock. So I am not a fan of businesses that do this. Typically, what I want is their free cash flows and operational free cash flows to be able to service any debts, any dividends, any share buyback plans currently approved by the board. And I definitely don't like it when they're using debt to service the shareholders here. However, in Walmart's case, given the current economic environment, I can see why they are doing this. And again, this is coming off a quarter which they expected to be slower than usual. So I want to keep watching this as to what happens with the back half of this year, especially with Q3 and Q4 approaching. These are going to be stronger quarters for businesses like Walmart and such. And this slowdown slowdown can be represented here when we look at this on a year-over-year perspective. Last year we had about $7.4 billion in free cash flow at this current time. Again, now we're down to $1.7 billion. Anyways, with all that, let's jump into our calculator here to see at what price point we'd be comfortable picking up shares of Walmart for margin of safety. So when we're analyzing Walmart here, let's put in our earnings per share figure. We estimated that by the end of the year they can come out with about $5 at least, especially when we anticipate that they have a strong Q3 and Q4. This is definitely achievable for them. With a 10% required return, they do actually pay a dividend as well. Let's assume, using our 5-year EPS growth rate, 3%, let's say, for the next 5 years, and then that continues to be around 3% for the next 10 years, let's say. On a 20 PE, this stock will be worth $91 for our margin of safety investment. Right now, we're sitting at $140 per share, so that makes this business a little bit too overpriced for us currently. So let's take a look at what analysts are projecting. If we come over here to our EPS growth rate, they're projecting that over the next few years, we can see growth rates from 8 to 9% here for the next 5 years. So if we plug that into our calculator here with 9% growth rate, then let's say it subdues again, because this is a mature business at the end of the day, down to, let's call it 4% on a 25 PE, the stock could be worth $140 per share, which it's currently at right now. Okay, and this would be indicative of a 10% required return per annum. So if you're comfortable with that analysis right there, please, again, do your own due diligence before you invest in any business. But according to this calculator, if we can achieve these growth metrics here, yes, the stock is fairly valued for a 10% return. Now, in the very worst case scenario, let's say there's a severe economic drawdown here for some time, they can't grow anymore, and actually they start to decline in growth rate here, 5% per year. On a 15 PE, this stock would be worth $55 per share. Again, this is in the very, very worst case scenario here. So as you can see with Walmart here, this was a much better buy when we first analyzed this business earlier this year. Now the valuation has changed a little bit. So that's the earnings update here for Walmart's Q2 2023 earnings results. I think at these levels now, it's getting a little bit too pricey for me. I liked it back down when it was closer to $120 per share. Now that it's up to $140 and going higher, I don't necessarily find this as attractive anymore. Again, closer to $100 per share, and I would love this business, but where it is right now currently, I'm going to sit out on this one and wait to see if it can go any lower. If you enjoyed the analysis and the value investing perspective, please leave a like and subscribe, and I'll catch you on the next one.